Good morning. I'm Julie Hyman with Jared Blickery in for Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, fresh eco data, wholesale inflation. It came in lower than expected in February, falling 0.1%, which is well below an expected rise of 0.3%. It's the second decline in the key reading in 3 months and hints at some easing of price pressures. U.S. retail sales also decreased, dropping 0.4%. That's in line with what the street was expecting. Of course, there are implications for the Fed that we'll get to in a moment. Second thing you need to know, in the wake of the SVB collapse, the Fed may be rethinking its game plan. The central bank is reportedly considering tightening its restrictions on mid-sized banks that hold assets worth between $100 billion and $250 billion. Under new supervisions, the banks would have stricter capital and liquidity requirements and a tougher annual stress test. That's an analysis to test whether a bank can withstand economic shocks. After the 2008 financial crisis, regulators rolled out strict rules on capital requirements and stress tests, but part of those rules were rolled back for these mid-sized banks in 2018. Third thing you need to know, more trouble at Credit Suisse. The cost of insuring bonds of the Swiss investment bank against default, they've hit their highest level on record. This after it delayed its annual report due to accounting issues. Credit default swaps, that's a way for investors to insure against the possibility of default. They were trading near distressed levels. The bank's in the middle of a 3-year restructuring effort, and it's had a rocky few years in an executive ranks at the bank. Now, let's talk about the implications of all of this. Jared's at the Wi-Fi Interactive for a check of the markets. First we had SVB, Credit Suisse now causing a lot of consternation in the banking world.
Yes, and to be fair here, Credit Suisse is a lot bigger than Silicon Valley Bank, about 2.5 times total assets. And let's just see what's happening in the stock futures in the U.S., and then we can check what's happening in the banking sector overnight. S&P futures down 1.86%. And if you see this chart, this is from midnight last night Eastern time, just a slow, steady decline, really accelerating during the European session. We can see the NASDAQ futures, they are off a little bit less than the Dow futures. Pretty similar story here. Do want to track what's happening with WTI crude oil. We are seeing it with a 69 handle. Haven't seen it below $70 in months and months. And so the global growth story now coming into question. And I want to show you what's going on in the bond market as well. 10-year T-note yield, that is down another 15 basis points. I'm going to show you a 3-month chart with candlesticks just so you can see. Last week we were at 4%. We hit 3.5%, actually lower than that. Bounced up yesterday and are back down. All of this translating into huge bond market volatility. This is a B of A move index. This is at the highest level. I'm going to put a 20-year chart. Guess what? We surpassed, and it's hard to see here, we surpassed the pandemic high, and we are now in territory that we haven't seen since the global financial crisis. So something to keep an eye on there. And all of this playing out with more fallout in the banking system. But this time it's not the regionals. We're worried about the majors, and specifically overseas. Credit Suisse, let's see if I can find it here. It is much smaller than it used to be. Down about 25% last time I checked. And as Julie, you were talking about just earlier, the cost to insure debt against default has just skyrocketed. Here it is, a 20-year chart. And you can see that this stock used to be, a $70, $80 stock. That was before the global financial crisis, a long time ago. Now $2.51. We're probably looking at, and we're going to talk about this a lot, we're going to talk about a potential restructuring of it, a sale. We don't know what's going to happen. But again, this is a European bank, different story than what happens with the American side of things. Julie.
Of course, but all of them are interconnected,
Very
right? And so that's why you have these concerns here that are now, everybody's sort of on edge following Silicon Valley Bank. And now that is infecting everything, even things that don't have to do directly with it. So we're going to talk much more about that. But let's talk much more about the economic data now, because wholesale inflation did slow in February. It dropped 4.6% on an annual basis. That's a smaller increase, or it was up 4.6%, I should say, which is a slowing of the rate of increase here. To put it another way, the final demand number fell to 0.1% month over month, although if you back out certain items, you saw increases. Still less than expected. Is this the disinflation we have been waiting for? Let's dive into it with Moody's Analytics economist Matt Collier. Matt, thanks so much for being here. So, is this the disinflation we've been waiting for?
Well, one, thanks for having me. The CPI data yesterday is what we're typically going to focus on and put more weight on. And in that respect, the moderation is ongoing. but it doesn't have kind of the certain warm feeling that we had towards the end of 2022 when the declines were a little bit more predictable and a little bit more comforting. Now there's been this morning PPI data aside, kind of a sputtering in that trend in early 2023, a slower moderation than we'd like to see, but still heading in the right direction.
And as you said, the Fed going to be looking more at consumer price inflation, the CPI numbers and PPI. Services still hot. We got that number yesterday. And now Fed Chair Jay Powell has a huge decision on his hands. Do you think, wearing your Powell hat, if you could for a second here, is he going to err on the side of financial stability, looking at all the regional bank failures, maybe what's happening with Credit Suisse today? Or is he going to look at that hot inflation data and say, okay, we've got to keep up the hawkish rhetoric and also action here?
I would say leapfrogging maybe oversimplifies it, but the financial system stability has leapfrogged inflation over the past week. So I think if I were Fed Chair Powell, and what we're thinking is that does take precedent when the FOMC meets next week, and caution is the method. So we expect a pause. That doesn't mean that rate cuts or rate hikes are done. This doesn't necessarily would be deemed a pivot as much as it's because of all the turmoil in the banking sector over the past week. Caution would mean let's wait to see that the financial system is on solid ground and we can pick back up our familiar fight, implementing restrictive policy when the group meets again in May. So that's our current estimation. That's a lot can change in a week, as we've seen. We're a week from that announcement, but that's our expectation for the near term.
And I guess we haven't talked a lot about retail sales, but retail sales also came in weaker than estimated, right? With the drop of, or I guess in line with estimates, but still a drop of 0.4%. How do we sort of put all this together, right? What do you think is driving that retail sales number lower? Is it that consumers are finally feeling some of the pinch from higher prices? What's going on there?
As you mentioned, it was expected, and that wasn't an expectation that February was the month that the tightening of purse strings was actually going to occur, although there's underlying details that suggest that is what happened to a degree. But largely that negative number, and you're not looking for a negative number when it comes to consumer spending, but that number was expected because of a lot of idiosyncratic things that happened in January. So that 3% number was revised up to 3.2% growth from December to January. We're looking at month-to-month changes. So an acceleration from January was never in the cards. Happy to talk more about those effects, but largely January was unusually warm. You have the cost of living adjustment for Social Security. Those are one-time effects that would make an increase in February really unlikely. That's why you see Wall Street, our expectations all for a decline from January to February. Motor vehicle sales is something we watch. It's very volatile. If you remove that, it's more of a sidestep from January to February. Inflation is eroding purchasing power. You are seeing household balance sheets come under a little bit of pressure, and that will hurt consumer spending. But February certainly isn't sounding the alarm in coming from the retail sales side of things.
And Matt, just thinking about the incredible volatility we've had in terms of economic data and the people's expectations over the last week. You said just a few minutes ago, a lot can change in a week. Sometimes everything seemingly can. And it was only last Tuesday that expectations for more hawkishness at the Fed grew because Fed was sitting in front, Chair Powell was sitting in front of Congress. We had a peak in interest rates on Wednesday and then this regional banking crisis. How do you, as a Moody's analyst, how do you prepare for this? How do you model the economy in this? And is the uncertainty just making a lot of these prognostications that more, I guess, arbitrary maybe?
It's been a 3-year lab experiment in modeling and forecasting.
Yeah.
So we're kind of used to a wider confidence interval, if you will. We can look at fundamentals and base our decisions based off of what history has shown us. That's how we come to the conclusion that this Silicon Valley Bank episode would be, that failure would be relatively contained because we do have data on credit quality. And is this and the kind of things that give us a degree of confidence that it's not necessarily a pervasive fissure in the financial system. And we can think, okay, if that's not going to happen from now until the Fed meets, that's probably too close to give the Fed any kind of confidence. But between now, if our expectations are correct, and there's not a wave of failing banks, particularly not large banks, given the capital requirements that they have and the stress testing they go through, you look out 6-7 more weeks from there, and you say when the Fed meets again, they'll have a little bit more confidence that the near-term rattling in the middle of March wasn't something that became kind of a secular crisis, and they can return to their fight against inflation. All right, that is our most plausible, our most likely scenario. But as you mentioned, there's certainly things that can happen that are very difficult to predict.
Yep, subject to change, and wish you all the best in your future lab experiments here. Really appreciate what you had to say here. Matt Collier, Moody's Analytics economist. The Federal Reserve is reportedly rethinking some of its rules when it comes to mid-sized banks following the collapse of SVB. The Fed weighing tougher capital and liquidity requirements for banks that hold assets between $100 billion to $250 billion. And Julie, we were talking about this yesterday and probably the day before as well. But I think this gets back to we're always fighting the last crisis, and the regulators are fighting the last crisis. You know, thinking about the GFC where we had credit risk, people didn't trust each other because they were doing potentially some shady things. Well, now we have all kinds of new problems here. We have interest rate volatility that we haven't seen since the early 80s. And so this is a different paradigm. And yes, it's not surprising that when we got all these, Dodd-Frank probably went too far, that pendulum, kind of swinging out that way. Now that it's come back, it's been revealed that, well, we were addressing the wrong thing. So is this a surprise? I don't think so. But it takes years to form these regulations and years for regulators to wrap their heads around it. What matters in the moment is what the Federal Reserve and what authorities do on an emergency basis. And once again, they have extended the lifeline and said we are going to save the depositors and the uninsured depositors, which was somewhat unexpected. Potentially a very good thing for, well, not potentially, it is a very good thing for all those uninsured depositors. But then on the flip side, that introduces moral hazard. And then the regulators and Congress have to figure this out for years, what they're going to do. And then there's another crisis.
And there's another crisis, maybe in a totally different spot.
I would think so.
Right. I mean, that is the concern here. Nonetheless, as we've talked about a lot with different guests in the past few days, many of them have pointed to the idea that these mid-sized banks were not subject to the same type of stress tests that the Federal Reserve does for the largest banks. And so in theory, it makes sense. Those mid-sized banks, including very specifically Silicon Valley Bank, had lobbied against having to abide by those more stringent regulations, arguing that it was too onerous for banks of that size. So all of this, as you say, makes sense in theory. Will it prevent the next crisis? Who knows, right?
At the end of the day, we have the Fed put. And I think if you're making a calculation, the folks at SVB who were neglecting their duties to hedge their interest rate structure, were they thinking in the back of their heads, okay, if this thing goes south, well, we got the Fed at our backs. I
don't know that people think in that explicit way, right? I think people just think nothing's going to go wrong. Or they ignore their voices in the head.
And incredible inertia. I mean, we're talking about things that took years and years to develop, and then we only find out about them in a few days. So there's that too.
And then on the flip side, the larger banks are getting larger as a result of all of this.
Yes, very important.
There's a report from Bloomberg that Bank of America alone has gotten $15 billion in new deposits after SVB collapsed. They're citing people familiar with the situation. And that's not surprising. That's something we talked about and theorized about, right? Because all these people who were no longer banking with SVB, that $200 billion in assets has got to go somewhere, right? Or the deposits, I should say, have to go somewhere. And so it's not surprising that they would be going to those kinds of areas. But then more risk then resides.
Yes, and we have too big or too fail. And you take a look at the net result here. The Federal Reserve with this new lending facility, which basically guarantees billions of dollars of deposits, that only facilitates the transfer of deposits from regional banks to the bigger banks, which is happening right now. It's not just the failed banks that people are withdrawing funds from. It is the non-failing banks as well. So. Go ahead.
I was just going to say, we've got a lot of people who have been weighing in all this in the past few days. The latest person I saw was Larry Fink of BlackRock, who came out with his annual letter to investors. And he said, we don't know yet whether the consequences of easy money and regulatory changes will cascade through the U.S. regional banking sector, akin to the S&L crisis, that's the savings and loan crisis, with more seizures and shutdowns coming. And this is also a question we've been discussing a lot of the past few days. What's next?
Yeah, well,
and we don't
a lot
have
of it
the answer to that
rests
yet.
with the Fed, what they do next week too.
Yeah, and we've seen a resumption in declines for many of those regional banks that had bounced yesterday.
Yes.
So we shall see. Well, speaking of banking and where risk resides and what people are worried about right now the attention has shifted to Credit Suisse. U.S. shares of the bank are sinking in pre-market, not just sinking, plunging, I think we can say, down 28%, hitting another all-time low this morning after the Swiss bank's largest investor, Saudi National Bank, said it's not going to put any more money into Credit Suisse. That's according to several media interviews. Saudi National Bank became the largest shareholder of Credit Suisse after $1.5 billion deal gave them a nearly 10% stake last year. We're going to break down all of the details on Credit Suisse, including a timeline of how it got here. This is a much larger bank than Silicon Valley Bank, by the way, and so we'll bring you perspective and context in just a bit.
Meta announced it would lay off at least 10,000 employees, its second round of steep job cuts in less than 5 months. It's part of CEO Mark Zuckerberg's Year of Efficiency, which is focused on training staff, cranking up profitability. And his philosophy isn't limited to Meta. Other tech giants like Tesla, Salesforce, Microsoft also slashing jobs in recent months. You can read all about it in the latest morning brief written by Miles Udlin over at the Yahoo Finance homepage. And joining us now to break down the latest is Paul Meeks, portfolio manager at Independent Wealth Solutions Management. And so, Paul, you've had a chance to peruse the latest data that we got out this morning as well. And we've also been talking about the Fed always fighting the last battle here. Just wondering, though, is it business as normal for Silicon Valley? Can they get back to, okay, we're going to ignore the mess in the economy and we're going to resume cutting jobs as normal?
I think we'll probably have more job cuts. Meta is a situation between last year's cut and the cut just announced, and then also taking off the table requisitions for new jobs. You're going to take about 25% of that workforce out. Now, there have been other companies, whether they're large, mid, or small in tech, that have been cutting jobs, but not to the tune of an all-in 25% workforce reduction. So that is significant. I think we'll see more of that. And then particularly with the news from Silicon Valley Bank, what you have is a situation that before that seizure, you already had very scant funding for venture capital. I expect that to continue. And when these startup firms can even get capital, it's going to be at pretty high onerous rates. And so you will definitely see, at least in the near term, a slowdown in the paid capital to Silicon Valley's innovation machine. In the meantime, the larger companies will continue to cut costs. The year of efficiency for probably all of them, I expect more and more of that. But what happens in a lot of things in life, the strong will get stronger. And some of these, not necessarily the FANGs, but some of these tech companies will come out of it. You thought they were the 800-pound gorilla. Now they're the 900-pound gorilla.
Is that a good thing, though, Paul, right? I mean, we were just talking about consolidation of power within the banking industry and how that increases risk potentially for the whole system. How do you think about that when it comes to the tech sector and the path of innovation?
Well, you always need to have an innovation machine, but I think the innovation machine is humming at some of these big companies. And because they're well capitalized, they can continue to. So yes, new technologies from people that we've never heard of before, you might have a slowdown there. But when you think about all the projects, whether it's artificial intelligence or other things going on at some of these behemoths, whether they are funding startup technologies themselves through direct investment, or they're cranking it out with their own R&D staffs, I don't know if we're going to miss that much of a beat.
I'm with you on the long term there, especially when it comes to AI development not taking a rest. But in the short term, you consider all the startups that are not getting funding right now. What do they usually use as service providers? We were talking to Bill Smead about this yesterday. He was saying, all right, you look at Microsoft, Amazon, which offers AWS, there's going to be a lot less demand, especially from new companies for these services, but also for existing companies, because a lot of that demand was pulled forward during the pandemic, and a lot of companies spent gangbusters on their IT budgets. Now what? So I'm just wondering what you think of tech maybe over the next year in that horizon, should the current malaise continue?
Oh, I expect the current malaise to continue, because when you see a company like Meta and a person like Mark Zuckerberg, who used to poo-poo cost cuts, and now he's with cost cuts like a dog with a bone, they're telling you that they not necessarily see a new normal where this lasts forever, but you're going to see subdued spending on both consumer and enterprise IT for some time. And so, yes, I would expect growth rates to come down. I expect expenses to continue to be cut. I think we'll get more of that when we have the next company's rounds of earnings reports. We'll probably get those about the 3rd or 4th week of April. But yes, I think it's going to be under pressure for some time. I'm a tech investor, so I have to invest in tech. So sometimes it's like buy the best house in a bad neighborhood. However, if you were more broader focused, I think you should take a look at tech in your portfolio, and I would advocate a underweight position until we've cleared all the bad news. And I just don't think we've cleared it yet.
Just real quickly on Meta specifically, Paul, has the company slashed enough? Has that specific company slashed enough at this point to start to get attractive to you?
Yeah, I actually think now the company is going to earn, I think, fairly easily $10 a share. It's trading at 19 times. That's in line to slightly higher than the market. And I think over time it will have, as we get through a recession and digital advertising returns, a growth profile better than the average U.S. company. So I think it is pretty attractive here. I can't, calibrate what's going to happen with Credit Suisse and the rollout with the rest of these banks. Right now, it's a macro, not micro-driven market. It's probably more interesting for even Meta shareholders to look at the macro versus what's going on at the company. But they have reduced and will continue to reduce. And I actually think the stock is pretty attractive here. I would like to see them, besides cost cutting and operational expense reductions, I'd like to see them do something with Reality Labs, because Reality Labs is the portion of the business that is a real cash burn. I'd like to see them slow down spending there, and then you have cost efficiencies on the operating side, and also cost efficiencies on their, let's call it a venture capital outfit with inside the firm. Then Meta gets really interesting. But right now, I think it's pretty good.
All right. Interesting stuff from you, Paul Meeks. Thanks so much for being here. It's always good to catch up with you. Independent Wealth Solutions Management Portfolio Manager, Paul Meeks. We've got some breaking news for you on the banking front. First Republic Bank now has been cut to junk by Standard & Poor's and is on negative watch. The shares are plunging once again here this morning. This is its long-term issuer credit rating going to BB plus from A-. What does that mean? It basically means people who hold this debt, they're now going to be seeing quite a different risk profile on that debt as it is now being deemed junk. We're going to talk more about the implications for all of this. And then we've got Credit Suisse to throw into the mix as well. So we'll give you a bigger look at the banking sector in just a moment as we bring you the opening bell. Credit Suisse has spent years trying to restructure its business. It lost 2 CEOs in 3 years. It had a spying scandal. We're going to talk more about all of that coming up. We're a few moments from the opening bell here, and as we mentioned, we just got some headlines on First Republic Bank. We're going to get to Credit Suisse in just a second. Just wanted to reiterate those First Republic Bank headlines, which is that it was cut to junk by S&P on the risk of outflows. Now, we've already seen a lot of money come out of the stock, right? And it's going down once again this morning, down by 25%. S&P saying we expect increased wholesale borrowings to further weigh on its net interest margin at First Republic. We believe that First Republic's deposit base is more concentrated than most large U.S. regional banks, which presents heightened funding risks in the current environment. That is effectively what happened at SVB. All of its depositors were from one industry, and so this is a risk that S&P is highlighting here at First Republic too, Jared. And
yes.
So you probably know a little bit more about this than I do. When a company's cut to junk, like what happens then to how the bonds are priced, to the people who already hold the debt at the company?
Great question, because we haven't really talked about the ratings agencies in 15 years?
Yeah.
Well, it's been sooner than that, but you get the idea, because we haven't had to, and now we're facing a banking crisis. Ratings agencies at the forefront, they are supposed to be the gatekeepers. They're judging the credit quality of certain issuers. The issuers are companies like these banks, or it could be the Gap, for instance. And when they issue these bonds, and Moody's will reduce the credit rating on it, guess what? The interest rate on those bonds that investors require jumps up. Meanwhile, the price of the bond goes down. So those two are inversely related. So as bond prices crash, the interest rate goes up, and then separately we have credit default swaps, which are bets on that debt defaulting. And so on Credit Suisse, for instance, now I'm switching gears, but we're going to Credit Suisse, that has blown out almost to about 1,000 basis points, or 10 percentage points. When we get to those levels, those are the levels at which banks historically have failed. So, we're not talking about FRC failing here right now, but another definition I'd like to get to are wholesale deposits. Why is it looking for wholesale deposits? Because as a bank, it has been losing deposits, and it has to find other deposits to match its liabilities and its assets elsewhere.
Right.
So it is going into the wholesale market looking for those. I've also read that FRC uniquely positioned to not be able to take advantage of the Fed's credit facility that had just opened up, because it doesn't have the kind of collateral that the Fed is looking for. So facing some unique challenges on its own there. And in the space that we've been talking about, I've watched over the last 5 minutes, went from down 15% to down 25, down 28%. So
yeah, I mean, so that's what's been going on there. Just to take a pause and concentrate on First Republic and some of the other banks that we're watching here for a moment, because basically what S&P here is doing is confirming what the market chatter has been, or reinforcing or highlighting what the market chatter has been, that there's these concerns that there is going to be perhaps runs on other banks like a First Republic, for example. And when you talk about the rating and the effect that this has with the rates going higher, in other words, if I, as an investor, am going to buy debt that is now being deemed junk, or the riskiest type of debt, I want to get paid for the risk I'm taking. So that, hence the interest rate on that type of credit or type of corporate bond going higher, making it worth my while to take that risk. So that's what's going on here. And just, again, this contagion that we are seeing potentially throughout the industry. We'll dive into Credit Suisse a little more in a moment, but there's the opening bell on Wall Street, sponsored by Tasty Trade, as we take a look at the major averages here. We had a little reprieve in sentiment yesterday, but that was short-lived, because now, once again, today, concerns coming back to the fore. What's interesting is that the setup from the economic data this morning should, in theory, have been positive. It gave cover for the Fed to indeed pause with its interest rate increases, because wholesale inflation was not hot. Retail sales were down. So that, combined with SVB, in theory would allow the Fed to pause. But maybe that's now been priced into the markets, and so they're moving on to the other risks here.
I think that's a great point, and I would point out, too, that maybe bad news is bad news once again, because if we're talking about the Fed pausing on interest rate hikes here, guess what that means? There's financial stability problems, and that is not going to be solved by the Fed in one meeting. We're not just going to have a resolution next week. There's going to be a longer, more protracted fallout. So even if the Fed pauses next week, that's not necessarily great for stocks, because that is an admission of something else going on. Now, let's take a look at the Wi-Fi Interactive. We have all the major indices indices in the red. Small caps, which were leading the way up yesterday, down by 2.5%. All the majors down more than 1%. And I want to get to the inside of the market here. Here's a look at the sector action. Everything in the red. To the upside, utilities, staples are the least bad. Those are defensive sectors. Energy, I mentioned towards the open or towards the beginning of the hour that crude oil had fallen below $70 a barrel for the first time in months. That is being reflected there. Financials, those are down 3%, not particularly a head scratcher there. Materials also down more than 2.5%. Let me take a look at our leaders. We had a lot of green on the screen yesterday, and now we're seeing value stocks. Those are up 1%. LQD, that is a corporate bond ETF for safe corporate bonds, that's up. And then meme stocks, maybe a head scratcher there. But to the downside, KRE, the regional banks, down another 5%. BETS, that is a gambling ETF, solar. Anyway, you get the picture. Very much a risk on yesterday, risk off market today. And let me just take a look at volatility, see what the VIX is doing. It had punched up above 30 a couple days ago. And we can see it's at about 27 right now. And let me just check the B of A Move Index once more and show everybody what's happening here. We had a huge jump up, and I couldn't even see it on the earlier chart that I was posting. I think it was at 169. There we go. Highest level that we have seen since the global financial crisis. So just goes to show you when we have this incredible volatility in the bond market and it leaks over into everything else, then kind of risk off here.
Yeah, most definitely. And then there's Credit Suisse, which
Yes.
I do want to delve into a little bit more right now. We have been watching this situation. It's the 8th straight session that the stock has been trading lower. It has been trading at a record low as well. The Saudi National Bank said they're not going to be putting any more money into Credit Suisse after a cash infusion they had already done. How is this being reflected in the market? Not just in the stock, which, as we mentioned, has been plunging, but also in the so-called credit default swaps here. What is a credit default swap? It's basically a type of insurance against default here that a company can buy. So one party purchases protection from another party against losses from the default of a borrower. Again, it's effectively insurance against a company defaulting, and the price of that insurance for Credit Suisse is now basically blowing out here. Another way to measure that is to look at the different curves, the credit default swap curve, if you will. It's inverted. That means it costs more to protect against an immediate default instead of a default down the line. That's another sign of distress when it comes to Credit Suisse. So there are a lot of different measures of concern and distress that is being felt at the bank here. The chairman of the bank, Axel Lehmann, saying at a conference that government help isn't a topic here, that they're not looking for government assistance.
Because it's understood?
I don't know, or because they don't think they're in that much trouble, or it's unclear. But I do want to kind of piece through how we got to this level, because people in the U.S. don't necessarily follow Credit Suisse that closely, but it is a large bank. It is its assets are more than $550 billion or so compared to Silicon Valley Bank at around $200 billion. So the timeline is long here. It goes back even further than this when you look at some of the issues. But Tidjane Thiam became the CEO, and he was the person who was meant, he was an outsider. He was not Swiss. He was meant to sort of turn things around. And then the company just got hit by various external and internal frauds. He ended up having to be forced to step down in 2020. And then in 2021, there were the failures of a couple of hedge funds and capital firms that were really tied to Credit Suisse, Greensill Capital, Archegos Capital, and that really then accelerated, I guess you could say, some of the issues at Credit Suisse.
It really reminds me of Bear Stearns back in the day. I guess we keep reverting to these 2008 crises parallels because, well, that was a banking crisis. Not that that's going to be the centerpiece, but that's what we're dealing with today. And back in 2008, Bear Stearns failed in March of that year. So we're looking at the 15-year anniversary. But the year before, the summer of 2007, we had a couple of hedge funds by Bear Stearns that went belly up. And that was a real harbinger of what was to come in the global financial crisis. So, yeah, looking back on this timeline, you can see some of the echoes, or at least some of the fingerprints that are similar between these two entities.
Right. So they there was a money laundering criminal conviction at a that was related to the bank that ended up happening in 2022. It was for money laundering in Switzerland. It was connected to a Bulgarian drug smuggling ring.
Yes.
You get the idea here. So the CEO that succeeded Tidjane Thiam was Thomas Gottstein. He was forced out. There was a new CEO, Ulrich Körner, that came in. And then back in October, the company cut 9,000 jobs. It got a capital injection at that point. It also ended up reporting a loss for last year. And then more recently, just in the past week, the company said it had found material weaknesses in its accounting and delayed its annual report. So that was tied up in the most recent slump that we've seen in the stock.
Right.
But more broadly, at a time when the international banking system is in a very delicate position because of SVB. They're worried about where the other vulnerabilities are. Here comes Credit Suisse with what look like a lot of vulnerabilities.
Yes. And let me I want to put this in the context of maybe a 50,000 foot view here. This is, we don't face anything like the situation that we faced in 2008 for a number of reasons. The Federal Reserve has just guaranteed all FDIC deposits above $250,000 in a bank. That means your money in a U.S. bank is safe right now. So all these people Googling, where is my money safe? Do I need to pull money out of my bank? Your money is safe if it's in an FDIC insured bank here in the US. What we're talking about are the effects for investors, people who have bought the bonds and stock of some of these banks. And then we're also separately talking about Credit Suisse, which is a European bank, and all their troubles right now and how that might be resolved. And we could talk about that for a while. There's contagion effects, yes, and there will probably be not just the 3 or 4 banks that we've seen run into trouble now. There'll probably be more, but does it develop into a full-blown crisis, or is it kind of a piecemeal thing where it's dragged out over years? I see it more like the .com crash where we had Enron, WorldCom, then we had in 2008 where we had a cascade of failures, everything at once.
Right, exactly. This does not feel like that.
Right, like the ground is falling out.
And I think that's a really good distinction that you made between like people holding money at banks. Do not go to your bank and pull out all your money. I think don't do that. If that's what people are thinking about out there, this does have implications for investments. It potentially has implications for the economy. Doesn't have implications for the safety of funds at FDIC insured institutions.
You bet. Signature Bank reportedly facing a criminal probe into its downfall. David Hollerith has the details. We're going to talk about that up next. Welcome back. More bad news coming to light for Signature Bank. U.S. prosecutors were reportedly investigating the now failed bank for its crypto client work before it was seized by regulators. That's according to Bloomberg. Yahoo Finance's David Hollerith joins us with the details. So, David, I guess not a big surprise here that crypto was somehow involved in one of these banks. It's a tangled web we weave here. What are the details?
Yeah, so Jared, like Silvergate Capital, which voluntarily shut down less than a week before Signature was closed, Signature was a crucial U.S. banking partner for crypto businesses. And as of the end of December, it was the largest U.S. bank in terms of crypto deposits. And as far back as late November, Signature had made efforts to say that it was reducing its exposure to crypto deposits as a share of total deposits. They plan to drop that from 20% to 15%. Now, interestingly, just to go through a list of some of the crypto firms that Signature banked, it includes the now bankrupt lender Voyager Digital, which is currently trying to sell its customer deposits to Binance US, which, as we know from bankruptcy documents, is under investigation by the SEC. It also was the banker for Binance International until January. Binance International has also been under investigation by the Justice Department for a number of years. Signature has also banked FTX and Alameda Research and was hit by a class action lawsuit in February where it was the accuser claimed that Signature was aware of and allowed the commingling of FTX assets, customer assets, through its Signet blockchain-based payment network, which allows crypto firms to bank outside of typical hours. Now, all this to say, in the Bloomberg report that we've seen this morning, it was pointed out by the Justice Department, the U.S. Attorney in Manhattan that essentially there was a statement that was put out by SEC Chair Gary Gensler. In that statement, Gensler said that the securities regulator has been monitoring the situation without speaking to any single firm. Would investigate and bring enforcement actions against any potential securities violations. So that's obviously, fairly vague and could mean a lot of things. But the fact that they pointed to that, it does make us wonder whether or not there might be more here than we know.
It's interesting, David, when we look at this bank. I mean, Signature's been around for a while, right? It's not always been a crypto bank because it existed before crypto existed. So what do we know about how much crypto played into the company's demise?
Yeah, Signature board member Barney Frank has after the closure, has been going out and talking to press. And he actually made claims that the culprit for why the bank saw high withdrawal rates at the end of last year, end of last week, was due to fear from crypto because of their crypto focus, given that Silvergate, another crypto-friendly U.S. bank, voluntarily closed last week. We also have statements from the regulator that actually shut down Signature, the New York State Department of Financial Services. And to paraphrase what they said crypto was not related to their decision for shutting down the business. They also said that after the run on deposits seen on Friday, which could have to do with Silvergate shutting down as well as SVB, which happened both in the days prior, they had worked with the bank officials over the weekend, and the bank had failed to provide reliable and consistent data, which created a significant crisis of confidence in the bank's leadership. And it was this decision to take over the bank that was mainly due to data and the fact that on Monday, the regulator did not expect Signature could open business and conduct it in a safe and sound manner. They also pointed out Signature's traditional business. We don't really have a breakout of how much was commercial real estate, but commercial real estate is a high percentage of deposits. And as Frank pointed out, it was a lot of those depositors that got scared around the end of last week.
Yeah, it makes sense. And then we see that herd mentality once that starts happening, whether it's at Signature or at SVB. Dave, thanks so much. Our Dave Hallerith. Coming up, the dollar is now stabilizing in the wake of the latest inflation data. We'll speak with an FX strategist about what could come next.
Welcome back. As markets continue to address the fallout of Silicon Valley Bank's collapse, investors are looking to the Fed for insight on how the crash will affect the next rate hike. Will the Fed stop early? Markets are betting heavily it will, but what could that mean for the strength of the U.S. dollar? For more on foreign exchange market, let's get to ING foreign exchange strategist Francesco Pesile. Francesco, thank you for joining us here today. Let me ask you about let's just start with the U.S. dollar, because we saw it strengthen last year as the Fed, as Jay Powell got incredibly hawkish. Then we got a reprieve, and the strong dollar has been a headwind for risk assets, and when it retreats, it's been a tailwind. And here we have a one-year chart of the U.S. dollar index. So I was talking about that strengthening over the last year, followed by the weakening since late last year. And again, we have this strengthening. A lot hinges on what the Fed does next week. Just wondering about your outlook for the dollar over the following weeks and months.
Yeah, well, everything looked pretty straightforward in a way up until kind of last week. The Fed had turned again very hawkish in its rhetoric, and up until the Silicon Valley Bank collapse, it looked like they would do either 25 basis points or 20 or 50 basis points at the March meeting. And now I think the question is whether they will hike rates at all. And I think at this point, given what's going on, it's looking likely that they might not hike at all. Now, the question is really how much does this matter for the dollar? And in our view, this may not matter all that much at a first impact, in the sense that the impact of short-term rate differentials on the dollar is not that huge at the moment. What really matters is how much and kind of turning to a dovish rhetoric actually manages to kind of calm markets' nerves and manages to stabilize market sentiment. So if indeed turning dovish ultimately triggers a rebound in market sentiment and equities rebound, then the dollar will fall. If it fails to do that, then the dollar will remain strong.
And what are you betting on in that scenario? Do you think that they'll succeed in that market calming?
Well, it's not easy to bet in such volatile markets, but I think the risks, the balance of risks is tilted for a weaker dollar at the moment. If we don't see kind of the Credit Suisse story get any worse than this. So, I mean, if we really see that contagion in European kind of banking stocks and banking system get much worse than this, then, you know, it's hard to see the dollar come back lower. It's simply because markets are going to look for safe havens, but regardless of what the Fed does.
Yeah.
And it's going to be much harder for the Fed to lift sentiment if, you know, there's such a major institution collapsing.
Francesco, I hear the difficulty ascribing probabilities to all of this because things are changing very much on a daily basis. I want to go to some theory here, and I'm going to go to the Wi-Fi Interactive, where I have the euro versus the yen, and this is a more exotic pair, but we were talking about the carry trade on the show yesterday, and this as a proxy for it. What we see here over the last 5 days, and this was really happening yesterday, was this acceleration. This was a weakening of the euro and a strengthening of the yen. And I want to put a 20-year chart on and show everybody what happened in prior crises. Now, in 2008, we had this top where we had the carry trade expressed in the euro yen. That peaked, and then we had a precipitous fall as the global financial crisis unraveled. And then we had a similar peak before the slowdown in 2015, 2016. I'm just wondering, do you think this peak has legs here? Do you think we're potentially seeing a topping? Because this would point to more of the end stage in the current business cycle where you see that money rushing back into the yen.
Yeah, well, you know, this is a very unique business cycle, unlike others. Obviously, the fact that we got out of the pandemic of such unique and huge monetary stimulus, and the fact that we are facing huge inflationary pressures across the world, and now this very sudden and very hard to predict kind of banking and financial crisis in the US, and now seemingly in the Eurozone, in Europe as well. I think when looking at the yen, you know, everyone was kind of saying it all depends on the Bank of Japan, whether they will turn hawkish, at what point they will turn hawkish, and that will allow the yen to rebound. At this point, everything has changed. The forces have changed in the FX market, because if indeed central banks are no longer reacting on the back of inflation simply, but on financial risk, on contagion risk of the banking sector, then the fact that the Bank of Japan stays dovish, it doesn't mean that the yen cannot rally, because the yen can simply rally on the risk of contagion, on the risk of financial risks. So we're back to a scenario that you just described, where essentially the yen simply rallies on safe haven. And you see today is the best performing currency in the G10 space.
Yeah, we're definitely in an environment where people are looking for safety. That is for sure. Francesco, thank you. Francesco Pizzoli, ING foreign exchange strategist. Appreciate it. We want to check on some trending tickers now. It's an unusual day when there are a lot of European trending tickers, and yet that is the situation in which we find ourselves today because of Credit Suisse and the concerns over that bank. We are seeing a number of shares, both the U.S. shares as well as even the foreign shares in the case of BNP, that are on our trending ticker list today and trading sharply lower. UBS, BNP, Deutsche Bank, and Barclays all getting caught up in the concerns over Credit Suisse and over what are looking like more and more close to distressed levels for the company's credit default swap. So what is going to happen to Credit Suisse? A lot of questions. And then what are the repercussions for the other European banks? We shall be continuing to track that quite closely, and we'll be right back.
Retail spending declined in February, indicating U.S. shoppers are calming their spending sprees, and that could be good news for the Fed, who are weighing a potential interest rate increase next week. But the outlook is cloudy in the rubble of SVB and Signature Bank's collapse. Joining us now in our next hour to break it all down is Raghu Rajan, University of Chicago Booth School of Professor of Finance and former governor of the Reserve Bank of India.
Yeah, that's going to be a really interesting conversation. In addition to that, streaming roundup. We'll speak with the CFO of Paramount on how that company is faring in the streaming war. That should also be a very interesting conversation. Stay with us. Welcome back to Yahoo Finance. I'm Julie Hyman with Jared Blickery, and let's take a look here at the latest market action. Obviously, we got economic data today. We got continued pressure on the banks today as well. Right now, the Dow is leading the way downward here, which is not what we have seen in recent days, right? We've seen the NASDAQ mostly lead things. So let's see. Will this magically work for me? No, it will not. So let's go on over to the heat map here because I do want to continue to watch the banks in today's session. They are helping lead the way downward. Actually, let's confirm that. Let's take a look at the sectors here. Actually, energy stocks are down more as a group because we've got a plunge in oil prices that is also occurring. Just to throw one more thing in today to everything else we're watching, oil prices have been down sharply, materials also down, and then you get to the financials, which are down 3%. Of course, the financials weighted more heavily, but all of the industry groups in the S&P 500, as represented here by the ETFs that track them, are trading lower. Now back to the banks here, because this is really continues to be the story that we're watching. Yes, we got the Fed. Yes, we got economic data. Yes, we got oil prices. But the banks here are in focus once again. A lot of that having to do with what is going on with Credit Suisse. It's up off the lows. Great. It's still down 18%, up off it was earlier down as much as 25% on concerns about just the bank's fundamental business, I guess you could say, and whether it's going to need more cash, whether it's going to be able to get it after one of its biggest investors said, well, it's not coming from us. Regional banks today, if you look at how they're performing, maybe not quite as bad as we have seen in recent days, but still not great, right? You got PacWest down 19%. You have First Republic, its debt was downgraded to junk over at Moody's, at S&P downgrading its debt to junk, so it's down another 12%. So still a lot of stress being felt here on the part of investors and wondering what's going to happen next. Well, what's going to happen next when it comes to the Fed? Expectations for Fed policy, they've become cloudy in the wake of the failure of Silicon Valley Bank and Signature for that matter. Here to round up the Wall Street chatter on interest rates, there is a lot of it. Yahoo Finance's Jen Schonberger is here with us now. Jen?
Good morning, Julie. That there is a lot of differing views on whether the Federal Reserve will raise rates at its next policy meeting in light of that somewhat hot CPI data we got yesterday. And in the midst of these bank failures in Silicon Valley Bank, take a look at the Fed funds futures this morning. They have been fluctuating quite a bit. As of 9:45 a.m. Eastern, the CME showing a 54% odds for a 25 basis point rate hike and 45% for no hike. How much has changed in just a week? A week ago, Powell opening the door for a 50 basis point rate hike. All of this after yesterday's consumer price index, excluding food and energy, showed that it rose 0.5% in February. That was a mild re-acceleration on a consecutive monthly basis, underscoring inflation remaining high here. So here's a look at how analysts' expectations are shaking out right now. In that 25 basis point rate hike camp, we have JP Morgan noting that strength in inflation is keeping pressure on the Fed to hike. Similarly, Morgan Stanley citing a strong reading on the services inflation, which necessitates a 25 basis point rate hike. Morgan Stanley economist Alan Zentner writing, we see the data firmly supporting another 25 basis point rate increase in March and risks of more elongated tightening cycle beyond our current forecast of a last hike in May. Now, also in that 25 basis point rate hike camp, Wilmington Trust and Piper Sandler. On the flip side, in the no hike camp, we've got Goldman Sachs holding on to its call for no rate hike, citing stress in the banking system. This is down from their previous expectation for a 25 basis point rate hike. Goldman Sachs's chief economist Jan Hatzius saying there is, quote, considerable uncertainty about the path beyond March. But he's leaving his expectations unchanged for 25 basis point rate hikes in May, June, and July. He expects the terminal rate to end at about 5.25% to 5.5%. Now, also in the no rate hike camp is Moody Analytics chief economist Mark Zandi, in light of the uncertainty in the banking system. And I just want to point out one outlier, Nomura Securities, calling for a 25 basis point rate cut and a halt in the wind down of the Fed's balance sheet in March. They are citing all of the turmoil in the banking system. They were in the 50 basis point rate hike camp even before Powell spoke. So just giving you a sense of how things have changed so much just over the past week. Of course, Julie, as you know, this all shaking out next Wednesday at 2 p.m.
Yeah, the suspense will not last much longer, but it is suspense given all of those notes. I mean, basically no one knows what they're going to do. Thanks so much, Jen. I appreciate it. Well, the Fed, as we've been discussing, is certainly in the spotlight as worries in the banking sector spread following the failure of Silicon Valley Bank. Now, the turmoil brewing at Credit Suisse. Here to discuss all this and more, backdrop for the economy, is Raghu Rajan, University of Chicago Booth School professor of finance and former governor of the Reserve Bank of India. Thank you so much for being here, because obviously, this is a confusing time with all of this going on. How does the Federal Reserve navigate all of this? What should they do?
Well, I think they have two problems, right? One is inflation. The other is financial stability. They would wish they had only one, and that was the case before Friday. Now, the betting, as you correctly said, was it was going to be 50 basis points with a strong CPI report on Tuesday. That's what we got. Labor markets are very tight still. Now, the reason the Fed sort of has probably taken 50 basis points off is that would be a pretty hard hike at this point when you have so much fragility. The question is 25 or zero. I doubt they will cut. Now, if they do zero, they will accompany it with very, very strong language saying, we're not pausing, we're just taking a break, looking at how the market settled down, and then we will potentially resume. But my sense is I would be in the 25 basis point camp. It does signal they're still concerned about inflation, and they do need to slow the economy down. Now, the question that would be on the Fed's mind is, with the financial sector turmoil, clearly, if it increases by the time they meet, they will be more tempted to zero. But also they will ask, will the financial sector turmoil and the concerns thereof make businesses more willing to lay off people, contribute to the slowing of the economy, so the financial sector turmoil will do part of the Fed's work. Now, that's not the ideal way to get the Fed's work done, but it can be part of the Fed's work, and therefore that may move them towards a zero. So what you said in the beginning, this is all up in the air, very confusing. My sense is the Fed would not want to send a strong signal that they're pausing, and they'll find some way to indicate that.
I want to draw on your experience here, having formerly been the governor of the Reserve Bank of India, also chief economist at the IMF, even vice chair at the BIS, the Bank for International Settlements, the so-called central bank of central banks. What are the types of conversations going on between Powell and some of his colleagues around the world right now?
Well, I think that people around the world want to know if the problems within the U.S. are contained. How big is this? How many banks have the problem that SVB had of lending long, borrowing short, and therefore subjecting themselves to huge interest rate mismatches, and therefore the kind of problem they saw. Now, that's the source of the systemic risk in the United States. How many small and medium banks have that kind of exposure? And do any large banks have that kind of exposure? That's what they want to know, because anything that happens in the US doesn't stay in the US, it transmits across the world. Now, that said, I think the problems with Credit Suisse are a little different. Credit Suisse is a bank in search of a business, and it hasn't quite found that. And as a result, the turmoil in Europe, and to some extent amongst the big banks in the US, is how much exposure do you have to Credit Suisse if it melts down over the next few days? So that's a different concern from the interest rate risk exposure that is the concern among small and medium banks in the US.
Well, and then when you speak about Credit Suisse as well, are there implications for the ECB, which is meeting tomorrow?
Absolutely. And my sense, again, is it's going to be a tough call for the ECB. They've signaled as hard as they can that core inflation, that is inflation without food and fuel, is too high in Europe. They need to bring it under control, and they've signaled as clearly as they can that they will do 50 basis points. It's going to be hard to climb down from that. I think they'll watch what happens, tomorrow morning while they're talking. But yeah, it's a tough decision.
I want to take a step back as well when we talk about the path of the economy from here. A note caught my eye this morning from Torsten Slok, who is chief economist at Apollo. He had talked about a no landing several weeks ago, and he said when the facts change, you change your view. He is now looking at a potential hard landing, so-called, in the U.S. economy. Do you think that that's what we're in for? You recently wrote an op-ed talking about the Fed's path here and how it's going to manage that landing scenario. What do you think that looks like now?
Well, I think it's really at this point, I think the chances of a soft landing are very, very small. That it's going to be a moderately hard landing or a really hard landing, and that can come in two ways. One, the inflation numbers still stay high. The Fed increases its hiking. It's not a financial sector-led slowdown, but it's an interest rate-led slowdown, and companies lay off more people. That has its own sort of momentum. As companies see more slack in the labor markets, they feel more comfortable laying off their people, and that builds up. And of course, layoffs lead to people having to sell homes. Homes sales lead to fall in house prices. You get a sort of bad sequence of events. You get a harder landing than the Fed wants. That's still a possibility out there. The other way things slow down is this financial sector concerns increase. You have a couple of accidents happening along the way. People get very concerned. They rein back their spending because they think the economy is slowing, just as it slowed during the global financial crisis. And that does the slowing for the Fed without it having to raise interest rates much more. But either way, the landing is harder than the soft landing that many people thought was a possibility. Now, the evidence is every single disinflationary episode since the 1950s has involved, at least a mild recession, if not a more serious recession.
Just thinking about some of the broader fallout from the regional banking failures that we've had in the U.S., we've seen a flight of deposit dollars. I read one headline, $15 billion made its way to Bank of America. It looks like the disparity between the tier one and the other banks is increasing. And so with all the talk 15 years ago about moral hazard and too big to fail, we have even bigger too big to fail potentially issues now. I'm just wondering what your thoughts are on that.
I mean, absolutely. I mean, the problem to some extent is regulation is often a good thing. It evens the playing field, right? When you know that your banks are well regulated, then you feel comfortable putting your money in. Now, what we've had is over the last few years, we've had the regulations on the small and medium banks alleviated somewhat, while the regulations on the large banks are still pretty strong. They, for example, have to meet the liquidity coverage ratio needs. So when people start waking up and saying, hey, my bank has risk, they ask, well, has this been regulated? And no, they reduce the regulations on my bank. Well, let me go to a bank that is well regulated, where I know they don't have hidden problems, where they have enough liquidity, and they're too big to fail. So this kind of flight, despite all the Fed has done in reassuring depositors they won't lose their money, in allowing banks to borrow against the full value of their bond portfolios, you're still going to have businesses saying, do I want to keep my money at this bank, which is at risk of failure, or do I want to move to something which has zero risk of failure? And that's the flight that you will see over the next few weeks. I hope it is contained, but it is something that is almost inevitable given the asymmetric regulation and the asymmetric concerns that have been raised recently.
Well, Rag, on a related note, this is something we've been asking a lot of folks. Is there now an implicit guarantee of all deposits in the U.S., no matter what size? And then what are the implications of that?
For now, yes. The problem is, obviously, this creates moral hazard, no matter which way you spin it. because large depositors are not now worried about the risk of putting their money in a bank, even if it is quote unquote uninsured. So how do you restore a sense of, that my money will be at risk? And that means that you probably have to implement stronger regulations at the banks so that the kind of systemic concerns that are at play here, how many banks have exposure to interest rate risk that I don't know about, which then cause the potential contagion? If it was only Silicon Valley Bank, you could have let it go, maybe dealt with the problem of entrepreneur funds being at risk. That would be a separate issue. Now you've offered a blanket guarantee because you don't know, and the public doesn't know how far the risks spread. And that's why it's very important to ensure systemic risks are contained, which means much stronger regulation on things like duration risk. Everybody's asking, how on earth did this bank take so much exposure to interest rate risk without the supervisors noting? We will have to have stronger regulation on that. You would have to, perhaps put the liquidity coverage ratios, which are protecting the large banks, on these smaller banks. Those are things that will be contemplated, I think, as we come out of this, and will be necessary to restore the sense that large depositors are at risk. There's no reason why the taxpayer or even other banks should be paying for them.
Right, which is what's happening right now. Raghu, this is really, really helpful perspective, and we really appreciate your time this morning. Raghu Rajan, University of Chicago Booth School Professor of Finance. Thank you. Coming up, how will SVB's failure affect the future of Silicon Valley startups and the culture there overall? We'll talk about that next. Let's do a quick check of the markets now, sponsored by Tasty Trade. We've got all three major averages in the red. As we've been discussing today, the Dow is leading the way downward. It's more heavily weighted towards financial names, for example, down 1.4%. The S&P off about 1 1/3, the NASDAQ down about 1%. We are seeing all three major averages off the lows of the session, but we continue to watch what's happening in the financial sector very, very closely. And as investors digest the fallout from Silicon Valley Bank and its collapse, our next guest is warning of the consequences this could have for startups in Silicon Valley. Epistrophe Capital managing member and Drill Down podcast host Corey Johnson is joining us now. Corey, it's fantastic to see you. Corey and I used to work together, of course, in prior lives. You have some really good perspective on this. You've been in the Valley for a long time. And I guess, first of all, it started us out with you're in a cool looking space there, but actually that feeds into the story that we've been discussing. So tell us about that.
Well, I'm in the San Francisco Ferry building at a place called Shack 15. And it's a private club, and it's also, there's a co-working space here where I'm surrounded by venture-backed entrepreneurs, many of whom worked as a financial partner with Silicon Valley Bank. And they were freaking out. I mean, people here, particularly on Friday, unable to get their money, unfamiliar with this. And I think it's we're at a point where you have a generation of people in technology who pretty much have seen technology go in one direction, employment go in one direction. You have many generations of investors who, over the long haul, have seen interest rates go in one direction. And that is technology going up for a generation, straight line, and interest rates for 2 or 3 generations going generally down. And you have both of those things changing at the same time. A run on a bank that people in this building, entrepreneurs who have staked their lives, they can program code, they can understand the block, they can read the blockchain, but they maybe not be able to read a financial statement. And I think there was a level of stress here that was really palpable.
I'll tell you what, I've read some bank financial statements, and I don't blame them for.
Exactly.
And let me just ask you, because on the ground there, Silicon Valley Bank, what is it, a 4-decade-old institution, has really become ingrained not only in the institutions there, but also the people who work for those institutions. It is the Bank of Silicon Valley. And can you just get from, I guess, a cultural perspective, tell us what the fallout is here?
Well, I think it's hard to understand how what it's like if you're a young person starting a business or an old person starting a business to walk into a bank and say, hey, I've got this idea, I've got this PowerPoint deck, I've shown it to 100 people and 5 of them want to give me some money, and it's 50 grand, or it's 150 grand, or it's $1 million. Would you please take me seriously? And Silicon Valley Bank will sit down with these entrepreneurs and roll out the red carpet and say, here's an account. Here's a credit card with a little bit of money on it. Here's some discounts you're going to get with Dropbox or with Google Analytics. We're going to have regular presentations on how to spruce up your pitch deck or how to deal with venture capital investors. Venture capitalists who are starting venture capital funds can go out and make an investment when they see a good deal and not have to make the capital call to their partners. They can just call Silicon Valley Bank and say, loan me the money for this ridiculous PowerPoint. I met this kid in a coffee shop with a PowerPoint slide. I think it's the next Google. Loan me the money. I've got the backing for my investors. I'll go to get their money later, but that way I can make the investment quick and not make this deal. That's not the kind of deal you can get from a money center bank in New York City. That's the kind of deal that Silicon Valley Bank recognized is how the next Facebook, the next Google, the next great invention from Silicon Valley, next Zoom, you name it, can happen out here, the next Uber, right? All of these things are happening under the nose of Silicon Valley Bank. They understand why that's a different kind of risk that other banks don't really understand because they're not here.
So where are these guys going to go now? I mean, we talked about a report earlier where Bank of America is gaining a lot of deposits from this. I doubt, I mean, I don't know, but I doubt Bank of America has that same kind of approach that you're discussing.
They don't. They absolutely don't. I mean, we've all had that experience as individuals using those banks. They don't care about the small guy. Even the bigger guys, they don't care about. And the small guys who can become big guys, they'll say, come see me later. So the question is, there's a societal question, right? How do we want, and you asked just the right question of your last guest, right? Do we want the money center banks that are too big to fail to get bigger? Or do we want diversity in lending? And I think the other thing that's missing here is, there's talk of should we have regulation, shouldn't we have regulation? Should we have bailouts of failed banks? Should the bailouts have limits on them? I think we also have to look at how the regulations work. The FDIC audits have been a joke. And we saw that with what happened with Silicon Valley Bank. If you talk to someone in the banking industry, they're terrified when the OCC comes in. But the FDIC audits, they think, are not as serious and worrisome. And so I think that, the regulations we have could work better if we gave the regulators the ability to do their job and the impetus to do that. And I think certainly they're going to be feeling that heat as well. But I think that, that's a kind of a different question about how the banking system works and how it can serve people. First Republic Bank now, and to be fair, we are owners of First Republic Bank now and long the stock. But my experience of them as a bank, terrific bank for individuals who've got money, terrific people to deal with. I think it's a fantastic franchise. They have not jumped into this Silicon Valley pond that is in their backyard. They have they've dispersed their investments across a lot of different places, I think, because they weren't comfortable with that risk. Now, Silicon Valley Bank grew a lot faster than First Republic as a result in the last 5 years. But they manage their risk in terms of their lending portfolio and their book of business very differently. And I do think there's a lot of money to be made to serve these entrepreneurs that are starting the future of America and the future of our world.
And that almost squeaked by me there. You own First Republic shares. You guys own First Republic shares.
Yeah.
How does that feel right now, Corey? I mean, especially S&P just
fun.
downgraded the debt to junk today. Are you adding more as this is all ongoing?
We're managing the position. It's a small position, but it does seem that, to the point, again, the point of your last guest, depositors are money good, and the market's treating them like they're money bad right now. There are some banks on sale. Maybe First Republic is one of them. But I think that, the baby is out with the bathwater. I do a podcast on a regular basis called The Drill Down, and we had the Washington Federal CEO on, another bank very concentrating in lending, in this case, lending into commercial real estate and within commercial real estate into apartments. He came with us on Friday and said, look, we're good. And our lending book is strong and our book of business is strong. And that stock actually rallied this week. Now, I don't take positions in things that we cover on the Drill Down podcast, but I think it was interesting to listen to the regional banks, at least one regional bank in this case, come out and say, we are money good right now, and our business is doing fine. And yes, there are going to be deposits looking for new homes. And I just hope as a citizen that is, and as someone deeply involved in this economy, that we have a diversity of lending and a diversity of risk, not all concentrated on a couple of banks in New York that maybe don't serve their customers as well as other smaller community banks can do so.
Agreed, and the devil is in the details. Really got a lot of that presentation and learned a few things. So thank you for your boots on the ground report there. Epistrophe Capital Managing Member and Drill Down Podcast host, Corey Johnson. Coming up, another lawsuit for Tesla. Pra is going to stop by discussing the latest accusations of the EV maker next. Tesla in the hot seat again as it faces yet another class action lawsuit. The EV maker is being sued by customers claiming sky-high prices and long wait times due to Tesla monopolizing repairs. Yahoo Finance's Praz Subramanian joins us now. Praz, I guess not a surprise because Tesla has a very proprietary car that they've engineered, and all these EV cars are relatively new. So it doesn't surprise me, but I'm wondering, like, what are the details here? And is there any chance that in the future we're going to have a more, I guess, unified repair structure for these vehicles?
Yeah, you know, Jared, it's funny. This is something that owners have been complaining about for a long time now. They can only use Tesla service centers or Tesla authorized service centers, and they can only get parts from Tesla. So what that means, they're waiting a long time for service, waiting a long time for parts, and then they're getting charged a lot on top of it. So I'm not surprised that they filed a class action lawsuit here alleging that Tesla is sort of monopolizing this whole system. But, you know, like a lot of automakers do face a lot of class action lawsuits from one party or another. Tesla is no exception. They've had some very, very high-profile ones. For instance, we had the Musk compensation trial, right? The one about his $50 billion pay package that's still actually ongoing now. That trial went on in November, still pending a actual ruling. Then we have the Musk cleared and the funding secured, the good old funding secured tweet that actually ended in February, and Tesla and Musk were cleared of any wrongdoing there. And finally, just a few weeks ago, suit in California alleging that the FSD and autopilot software, that Tesla was sort of defrauding investors over the software capability. So that trial actually going to probably go to trial soon, but it also follows another trial in FSD that happened in August. So a lot going on there, but some of the high profile ones sort of around Musk and Tesla's capabilities.
Well, I mean, as you mentioned, automakers, you know, not just automakers, like class action suits are out there against a lot of different companies. So how can we put these in perspective in terms of how serious they are, in terms of how investors need to think about them? How should we sort of contextualize? You
know, I think something like this service center suit is not that big of a deal, honestly, just the latest news peg. But what's funny about these suits is sort of Musk is sort of front and center in a few of them, right? In particular, his pay package and then also the funding secured tweet. You don't see Mary Barra tweeting about stuff like that, right? So I think.
Does she tweet at all? I don't even know.
Good point.
Yeah. Exactly. Well, she's at South by Southwest, just kind of, you know, most of these CEOs are sort of in the back talking about the company. So I think this is the big issue, is that Musk sort of inserting himself into these big controversies, and then as an investor, you have to sort of follow along and hopefully not get burned by it. So I think that's why we sort of kind of focus on some of these suits more than other automakers, because other automakers, more traditional stuff, issues about the cars and maybe shareholders weren't privy to some information. In this case, you see this high-profile Musk action happening. So I think that's sort of what the difference is between the two.
By the way, I just confirmed she does have a Twitter account. Her last tweet was the 27th of October, and it was a retweet from Cruz. But she, you know, it's a little bit of different of a Twitter profile than Musk.
No CEO risk there.
No, definitely not. Avoiding it at all costs. All right, thanks so much, Praz. Appreciate it. Coming up, Paramount CFO will join us for a pulse check on the streaming wars. We'll be right back. Paramount Plus is gaining ground in the streaming landscape. Its show Yellowstone ranked as the most popular series of 2022 in YouGov's Global Film and TV report. And Top Gun Maverick was no sleeper either, ranked as the highest appetite score for a movie last year. Joining us now to discuss all things streaming is Paramount CFO Naveen Chopra, along with Yahoo Finance's Brian Sozzi, who I think has seen Top Gun Maverick.
3 times.
3 times.
Okay.
I suspected that was the case. Naveen, thank you so much for being here.
Thanks for having me. It's great to be here.
You guys have just come out strong out of the gate in terms of this streaming product. How do you think about now the next phase of growth and how you're going to attack it and keep, well, I don't know if you can keep up the same pace of growth, but how you're thinking about the strategy?
Yeah, well, as you said, I mean, 22 was just an incredible year for us with Paramount Plus. And in fact, since we launched Paramount Plus back in 21, it's been the fastest growing major streaming service. And that's been overwhelmingly driven by content. Things like 1883, the reboot of Criminal Minds, movies like Top Gun Maverick, which you mentioned, Smile, big time sports, the NFL, Champions League soccer. And we got a whole lot more of that coming in 23, both with respect to new seasons of favorite franchises, new original content, an incredible movie slate. And so we're going to continue to lean into everything we're doing from a content perspective. But we're also looking to continue to evolve the business model. We've been very focused on building scale, both with respect to subscribers and revenue. And now we're focused on the path to profitability, which has always been part of the evolution that we knew we had to execute against. And we're now getting closer to the inflection point, going from investing more to ultimately the path to profitability.
Is this year peak investment in the DTC business, and when do you see profits in streaming?
We have said for quite some time that 2023 will be the year of peak investment in streaming for Paramount. That's a function of the fact we've been ramping up both our content slate as well as expanding distribution on a global basis. And as I said, we've been very pleased with the success there. I think it's fair to say that we've exceeded expectations on almost all of those dimensions. You know, we added over 23 million subscribers in 2022. Our total streaming business now has a revenue run rate of over $5.5 billion. So now we are starting to use that scale to drive toward profitability. We haven't put a specific timeline on that, but we do think as we move from 23 into 24, we'll see meaningful improvement in total company, both earnings and cash flow, which is obviously something that we think can be helpful in terms of the way investors look at the company and how they value the business.
How much, in terms of just consumers being receptive on higher prices, so Netflix out there raising prices, Disney Plus raising prices, at what point do consumers just say, I'm going to start cutting some of these services?
You know, we think streaming still offers tremendous value for consumers relative to, for instance, what they were paying 5 or 6 years ago for entertainment. The appetite for great content has not changed at all. In fact, that's only continued to grow. And even today, if you subscribe to 5 or 6 different streaming services, you're still probably paying less than you were not that long ago for the traditional cable bundle. So we think there's a lot of legs in it. And in fact, there's a lot of research that shows streaming remains sort of at the very bottom of the list of things that people are willing to consider cutting, even in tough economic times.
I'd have to agree that the value to consumers is definitely there. It's also become a bit more a bit bewildering given all the choices out there. Just wondering what you're considering and seeing in terms of partnerships with other streaming services. The entire landscape has been crowded for a time, but just wondering how you see it evolving and shaking out, not only for you, but maybe some of your competitors.
There's no doubt that crowding has been a concern and I think a frustration for consumers. I think there's 2 things that we've been focused on at Paramount Plus to help cut through that. Number one, we're big believers in franchises. You look at the content that we have had a lot of success with on Paramount Plus. It's a lot of franchise content, whether that's big movies that we bring from theatrical releases or even things like Yellowstone, where we've created a whole universe around that that has a built-in, very loyal, very passionate audience. We've also really embraced partnerships of all different shapes and forms. We have partners here in the US, for instance, with Walmart, where we're bundled with Walmart Plus. We've announced a partnership with Delta Airlines that'll be launching recently, where people will have the ability to see and experience Paramount Plus in flight. And we've got a variety of partnerships outside the United States that have been big drivers of growth. And those partners really help amplify our marketing and drive the awareness that we want consumers to have for Paramount Plus.
Of course, as you guys have really focused on this streaming strategy at core, you've tried to get rid of non-core assets. Simon & Schuster, I know, is something that's in process. BET is something that's been reported upon. What can you tell us about that and where you are in that process?
Yeah, as you mentioned, we continue to look at opportunities to divest Simon & Schuster. It's a great business, but it's one that is not core to our current mission of focusing on video. There's been speculation around BET. We don't comment on M&A speculation, and I don't think it would be appropriate for me to do so here. But I will say that in general, we are always looking at different ways to create value for our shareholders, and to the extent that there are ways to do that by buying assets, by selling assets, by restructuring assets, we look at all of those very carefully. We study them, and ultimately, to the extent there's an opportunity to create value for shareholders, we'll pursue it.
Naveen, you're out in the market now with a new campaign. Popular is Paramount. How do you measure a return on that type of investment? Do you expect a subscriber lift?
Yeah, thank you for asking about that, Brian. We're really excited about that campaign. Popular is Paramount is really all about helping people understand the scale and power of our content. You mentioned it. Top Gun has obviously been the biggest movie domestic movie in 2022. Yellowstone, #1 show on television. CBS, #1 network now for 15 years running. But what you may not realize is the fact that, for instance, in the fourth quarter, domestic consumers spent 370 billion minutes consuming just CBS content on our linear and digital platforms. That's the same amount of time that was spent consuming the entire slate of Netflix original content. So we want people to understand the scale and the influence of what we bring to the table, because it unlocks a lot of value for our advertisers, our partners, and of course, our customers.
Yeah, interesting perspective there, because we talk a lot about Netflix.
Kevin Costner, is he staying at Yellowstone? You know I had to ask this stuff. I'm a fan.
Well, everyone's a fan of Yellowstone. #1 show on television, as we've mentioned a couple times. Kevin's been an incredible contributor. We appreciate everything he's done for the show, and we hope we can continue it. But if that's not in the cards, we've done a great job expanding the storyline and the broader Yellowstone universe. And there are obviously different paths that we can take if we have to.
I'm caught up on every episode, guys. Just want to let you know that.
All right, obviously I have to do the same. Naveen, thank you so much. Thanks for
having
coming in.
me.
It's good to see you in person.
You too. Take care.
Naveen Chopra is the CFO of Paramount, and of course our Brian Sazzi. Let's get a quick check on markets, because we're noticing that once again things have sort of legged lower. The Dow is now down about 1.8%, nearly 600 points here. The S&P off 1.7%, the Nasdaq got down 1.4%. We've seen heavy weights today from the likes of energy and materials, as well as what we've seen in the selling in the financials. We're going to keep on tracking it for you. And coming up, as the tax deadline approaches, we'll break down how you could stand to gain in this year's filing, especially after maybe some losses in your portfolio last year. We'll be right back.
Welcome back, and let's face it, 2022 was tough for finances. The year marked one of the worst performances of the S&P 500 in at least 90 years by some metrics, with the stock index falling by more than 19%. But you can use those losses to your benefit when filing taxes. Joining us now is Dan Geltrude, founder of Geltrude Company, helping many make taxes simple as part of our series brought to you by Fidelity Investments. Dan, great to have you here today. So in light of all the news that we've been talking about, not only for the last few hours, but the last few days, what are some tax tips that you can give investors who may be sitting on some losses here, may have exposure to some sectors which are getting hurt?
So to begin with, you always have to think when it comes to investment strategy, it's not how much you make, it's about how much you keep. So investment strategy and tax strategy go together. So if you are sitting on losses, what do you do? Now, keep in mind, there's no tax impact unless you realize those gains or losses. So to begin with, if you have realized capital losses, meaning you've actually sold a stock at a loss, you can offset those losses against your capital gains. But again, you must sell the investment, realize the gain, and then offset the two. Now, you can offset all of your capital gains with capital losses to the extent you have that many capital losses. Now, if you have losses and you don't have gains to offset, you do have the ability to carry over those losses to future years. And also keep in mind that the limitation of not having gains is $3,000. So let's just say you have $10,000 of capital losses and you have no capital gains, then you can use only up to $3,000 of those capital losses. Now, keep one more thing in mind. What we're talking about is federal taxes. Each state has different rules related to how capital losses are handled. Some states, if you don't use your capital loss in the year in which you realized it, you lose it. So it's a little bit of a juggling act between what goes on the federal side and what happens on the state side.
Hey, Dan, it's Julie here. It is great to get some time with you. And that is really helpful information, I think, after the year that a lot of people had in the markets and how they should be thinking about their gains and losses. Another thing that is tricky about this current environment is, unfortunately, we're seeing it in an uptick in layoffs at many companies. And I wonder from a tax perspective, particularly if people, say, lost their jobs after the end of the calendar year, what they need to be aware of from a tax perspective.
So to begin with, the first thing and most important thing to realize is that there is no tax credit or tax deduction related to losing your job. So you can't think of that, say, well, there's going to be some direct benefit there. The other thing to keep in mind, if you do lose your job and you start to collect unemployment benefits, that is going to be taxable federally. Now, there was a period of time where they waived the taxability on unemployment benefits, but that is now over. So keep in mind, any money that you get from unemployment benefits will be taxable federally. And depending on where you are, it may or may not be taxable from a state standpoint. So you need to think about your tax liabilities going forward, because if you don't have any withholding taken from those unemployment benefits, you may end up having to owe unexpectedly when you file your tax return. Now, due to the loss of income when you lose your job, you may qualify for the earned income tax credit or the child tax credit. But that's not because you're getting unemployment benefits. It's because you would have had a loss of wages, and therefore you may qualify for those two credits.
Dan, we got another minute here. Just wondering what type of calls you're fielding from clients or just concerns in general and how you're addressing those.
Well, the calls primarily right now relate to what's going on with the banks, right? Because people are asking the question, is my money safe? And basically what I tell them is, have you been managing your balances, making sure you're under the FDIC insured limits, number one. And number two, I tell people, look, be concerned. It is not time to panic. So we don't need everybody running to the banks and say, give me all my money. We are not at that point. But again, you want to be mindful of where your money is and what your balances are.
Yeah, I would be more concerned if I had 250 grand in cash sitting at my house than sitting in a bank. That's for sure. Dan, great to see you. Dan Geltrude, Geltrude & Company founder, with some helpful tax tips today. Appreciate it.
Thank you.
And we want to check on oil prices here because we are seeing a rapidly deteriorating oil picture, Jared.
Yes.
Oil is now below $68 a barrel, down 5% today.
Yes, and that is reflecting the lower demand expectations that we are heading into recession, not only in the U.S., but potentially globally. And we haven't seen these prices since over a year ago, January of 2022. If we take a look at the Wi-Fi Interactive here, I can chart it real quickly. Here's crude down over 5% today, 67.42. And indeed, the lowest prices in crude since late 2021. Also want to check in on the Goldman Sachs commodity index here, and that is not it. That is actually at the lowest price since about, there we go, 14-month low there for the S&P GSCI index as well, Julian.
Yeah, as we've been talking about, energy stocks among the worst performers on the day, even at, I mean, there's a lot to choose from today, with the banks selling off sharply as well. So we're going to keep on tracking all of this action, and in particular, the action with Credit Suisse. Rochelle Akufo's got you for the next hour. She will continue our coverage of that European bank and the troubles that it is having, the latest concern for the global financial system.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks fall as fears over the financial sector spread to Europe, and Swiss investment bank Credit Suisse. It's lost 2 CEOs in the last 3 years, had a spying scandal, and lost billions in a hedge fund collapse. Is the current landscape the final straw for investors? And the fallout from SVB continues, with the Federal Reserve reportedly looking at tougher capital rules for mid-sized banks. Shares in First Republic not having a good day following a junk rating from S&P. This following Moody's downgrade of the wider US banking system. And of course, all this matters for the Fed, of course. Expectations for next week's rate decision fluctuate as JP Morgan sees a 25 basis point hike on the cards. Worth keeping an eye on the bond market, with 2-year yields falling amid choppy trade. But first, let's take a look at how all this is impacting the major indices. As we can see there, some of the sell-off continuing. We'll start with the Treasury yields here. You see that the short term, though, down almost 8% on the day. That flight to safety, meaning there's less yields to go around. The 10-year also down about 5.5% as well. The longer terms down about 3.25% on the day. Let's also check on how the major indices are doing, because we've seen all 3 of those major indices under pressure as well. Especially, they're off their session lows at the moment, but still in very deeply negative territory. The Dow there off more than 500 points. The S&P 500 there down more than 1.5%, and the Nasdaq there down just over 1%. Financials adding a lot of pressure to the markets today. Well, expectations for a Fed policy is a mixed bag in the wake of Silicon Valley Bank's collapse and the slightly hot February CPI report. Now, JP Morgan expecting a 25 basis point rate hike, noting that strength in inflation keeps pressure on the Fed to raise rates. Morgan Stanley similarly echoing the same rate increase, citing the strong reading on services inflation. Wilmington Trust and Piper Sandler also in on that 25 basis point rate hike camp. On the other hand, though, Goldman Sachs holding to its call of the Fed not hiking rates at its next meeting, citing the stress in the banking system. Now, this is down from its previous expectation of a 25 basis point increase. And as investors await the Fed's decision later this month, the European Central Bank will be announcing its rate decision on Thursday. Now, expectations are set for a 0.5 percentage point hike. That's despite the banking turmoil. However, concerns over the recent Credit Suisse meltdown places the ECB in a bind as it looks to maintain its course on tackling inflation. Well, here for a deeper dive on the state of the banking sector and more is Michael Vogelsang, Cap Trust CIO. Good to see you, Michael. So as we're watching all of this unfold, a lot of questions here. Is this a bailout? What would you call this at this point for SVB?
Well, I think the whole SVB thing is about a circumstance that is clearly a bailout, right? The government is expanding capability, it's protecting depositors. They've chosen not to protect bondholders or shareholders at the moment. There's questions of equity there actually, but yes, it's definitely a bailout to use that word. But our worry is again pretty simple. The Federal Reserve has been both fighting inflation, and now it has to fight a banking crisis brought on by its own hands. As my favorite analogy is this week, they're both the pyromaniac and the firefighter. And that's a pretty precarious position for the Fed to be in. If they back off on inflation and we get a rebound in inflation, which we don't believe, by the way, that could put them in a really difficult circumstance. So what we're really seeing is fallout from an aggressive Fed campaign to tamp down inflation globally.
And we knew that Credit Suisse was already under pressure even before this. We saw the rumblings in the background. Its failed acquisition of First Boston Corp, that didn't pan out for them very well, and also a number of scandals as well. But now, of course, its top shareholder ruling out that it's going to be backing them, providing more assistance at this point. How much of this is just bad timing versus something more systemic that we should be keeping an eye on?
Certainly bad timing, but that doesn't mean it's not systemic. I think for 12 or 14 years since the global financial crisis, cash and monetary conditions have been super easy. Every bank feels comfortable when deposits are flowing in, when cash is available, when interest rates are low. What we're seeing now is, of course, the impact of the reversing of that strategy. Tight money, higher interest rates. And so, sure, Credit Suisse is a specific thing. And by the way, the chairman of the Saudi bank isn't exactly JP Morgan, right? Walking the streets and saying, we're going to start to buy today. He's doing the opposite thing and setting off the markets this morning. But This is again a fallout of a new regime in monetary policy, and we've been fairly cautiously positioned in our portfolios, not knowing what would break, but knowing something probably would, and certainly something has. We'll see how the Fed fights it. I think the 2-year Treasury note is really the important number here, and we've seen that fall from 5% to where it is today, 370 or something like that, in a matter of days. A breathtaking drop in yields in the short term, and that's just saying that the Fed's going to have to lower rates before they raise them.
And you mentioned this idea of really sort of seeing some of the writing on the wall as interest rates started to rise, especially when you look at the SVB story. I mean, they invested in high quality bonds, kept them on their balance sheet, pretty standard practice. But when we did start to see interest rates rise, what were some of the missteps or things that could have been handled better, if anything, to try and prevent this situation?
Well, it is hard to play the blame game quite yet. There's plenty of blame to go around. I think systematically, the Federal Reserve has raised rates incredibly quickly. And they have to know that's going to create some distress and stress in various parts of the financial markets. That clearly has been seen now. In terms of SVB and other banks in their circumstance, or at least similar, could they have done a better job of hedging some of that interest rate risk and that duration risk? Absolutely. Not being with a chief risk officer for an incredibly important period of time when rates are going up, I think must have contributed. I don't know. I wasn't in the room, but basic missed worries about the exact outcome. And then, of course, having the CEO selling shares literally weeks before this doesn't look good either. So, there's clearly some challenges there. The shareholders are going to be left to pick up the pieces. I think the markets right now are playing the next game, right? Who's going to be next? We see First Republic struggling in a significant way. There's others that are as well. Again, this comes back to a very, very simple proposition. When the Federal Reserve takes rates from 0 to 4 3/4 in the course of a year, things are going to be stressful, and we're seeing that stress play out.
And you mentioned First Republic there. They did get at least some infusion of liquidity from the FDIC and from JP Morgan as well. Obviously, a different situation from the backstop that we saw with SVP. How much contagion are you expecting here? A lot of people saying perhaps it's more contained. Others saying this is a canary in the coal mine circa 2008. Where do you lie with this?
It's certainly, I'm not sure we know yet. And people who say they know, I think, are jumping the gun. If the Fed's actions on Sunday evening, and look, there was a huge, group of people working all weekend to understand the impacts of what happened at SVB, and I think the Fed and the U.S. Treasury's moves on Sunday evening really did a lot to calm the nerves and to stem some of the tide. The problem is going to be now. This becomes a psychological game of, again, gotcha. Who's next? Where should the shorts come in? Who's spreading rumors on social media? How quickly are people taking money out of their banks with their cell phones? Right? You don't have to go line up at your local bank anymore. This isn't It's a Wonderful Life. This is, you can move money instantaneously as a client and as a customer of a bank. So all of those things are new, and they change the dynamics of what we're trying to understand. And so it is really hard to know with precision and foresight whether or not this is just simply the first step in a problem or not. What we do know is that lots of banks have bonds that are underwater on their balance sheet, right? That we know, and I'm not sure people were focused on it before this, but clearly with folks like First Republic and the other banks that are struggling, and some of the financial services companies in general, we're gonna see more signs of stress, which is why understanding whether the Fed's going to continue to raise rates or actually cut rates now will be the next big the big tell, I think, of where we're headed.
Certainly extra pressure going into that FOMC meeting this month. A big thank you there to Michael Vogelzang, CapTrust CIO. Thank you for your time this morning. Well, shares of UBS sliding to the downside as it gets caught up in the worries surrounding rival Swiss bank Credit Suisse. Concerns on the future of Credit Suisse grew after its largest investor said it could not provide any more financial assistance due to it being a regulatory issue. Now, this comes after Credit Suisse on Tuesday published its annual report, noting it found, quote, material weakness in controls over financial reporting. All right, coming up, getting charged. The Biden-Harris administration opens applications for a new multi-billion-dollar program to fund electric vehicle charging in communities. We'll speak with a company that has skin in the game next. Today, the Biden-Harris administration opened applications for a new multi-billion-dollar program to fund electric vehicle charging in communities nationwide, as well as along designated highways, interstates, and major highways. Now, this is a key step towards the president's goal of building a national network of 500,000 public EV charging stations by the year 2030. Now, EV charging provider Charge Enterprises is currently developing charging and 5G solutions nationwide. It also released fourth quarter earnings this morning. The company's founder, CEO, and chairman Andrew Fox joins us now to discuss the outlook for EV charging. Thank you so much for joining me this morning. So I first do want to talk about this goal of President Biden here, 500,000 public EV stations, and that's also pairing with trying to cut national greenhouse gas emissions in half by the year 2030 as well. How do you see Charge's role in this?
Well, first of all, thank you for having me here, and good morning. I think the federal government must play a role in building this infrastructure, at least providing the incentives. And companies like ours are at the forefront of really, it's almost like being at the dawn of the cell phone industry. In the beginning of the cell phone industry, no one really contemplated just how important the infrastructure was. And now you're seeing today at 5G, speeds continue to increase. And so this incentive and program by the administration, I think, is a welcome relief. But I think there's going to be a lot more to come in the coming years because this is a vast undertaking. And the kind of work that we do creates great jobs. But I don't think people realize just how much of this infrastructure needs to be built today in order to see the evolution of this clean tech on the roads.
And you have said the Charge is positioned to capitalize on the next generation of the energy transition. How so? And how much of that came up in what happened with your Q4 reports?
Well, we grew our revenue last year from 470 million to just under 698 million to be exact. And what you're seeing is there's an increased demand for infrastructure. And I think that, in boom times, this type of service is not as sexy as other industries. But I think that if you're looking for safety and access to the electric vehicle market and you want exposure, I think companies like ours that are providing the infrastructure are going to be a lot safer because they're not as commoditized. And so I think it's an important next step. We're at the forefront. And so what we do is we design, engineer, install, and maintain equipment for everybody. And you'll see this past week, we just did another major deal with Octel, which is a major company that provides EV hardware. And I think you'll continue to see big global companies get into this infrastructure space on the hardware side, and then need companies like ours to actually install it and maintain it for them.
And I mean, we are seeing that the stock price is under some pressure today, perhaps investors focusing on some of the net losses here. Do you think the stock is being unfairly punished here? What do you think investors are focusing on?
I have such a long-term view on our business, and we're only in our fourth year and only barely 1 year on NASDAQ. And so misery certainly loves company in the stock market, but I'm not focused on our stock price. I'm focused on building an unbelievable business. And I believe in the short term and in the long term, as infrastructure becomes more and more important, our stock price will take care of itself. The things that I'm looking for in a business right now, and these are the most important things: revenue growth, gross profit growth, customer retention, and referrals. And so those lights are all flashing green. And I think that, despite some of the macro environment around the equity market, companies like ours will not only survive, but prosper as the market starts to come back to reality.
I mean, this does seem to be a longer play. I'm looking at data from the S&P Global Mobility. They're forecasting, when you look at the infrastructure for this, including in-home charging, the US is going to need to quadruple the number of EV chargers between 2022 and 2025 and grow them more than eightfold by 2030 to meet some of the forecast for sales that we're expecting here. How far behind, then, is the charging infrastructure here in the US versus the demand that's being projected here?
I mean, it creates a great opportunity. And when you look at 2035 numbers, so we have about 4 million electric vehicles on the road today. That number is supposed to 10x by the end of the decade, and then almost double by 2035. And so you're talking about unbelievable opportunity for infrastructure companies like ours to provide long-term solutions. And so this is, if you're using a baseball game analogy, we're like one out in the top half of the first inning. And so it's a really exciting time to be on the infrastructure side.
And I want to ask you about how dealerships are dealing with this transition as we're expecting this, as you mentioned, there's some of this 10x growth in EVs. What does this mean for dealerships that are trying to transition to this?
Well, as they're transitioning from ICE to EV, their big challenge is they really now have to contemplate the infrastructure and how they're going to sell and service vehicles fully charged. And are they going to eventually be building networks that subsidize some of the federal government ambitions? And so there's really a big, kind of think tank of sorts going on at the dealerships. That's who we primarily focus on, because what we see is they're the only private sector with a mandate to install infrastructure. And we get a kind of bird's eye view as the entire EV ecosystem as it's evolving, because we see where the cars are being sold first and foremost. And so we have a very heavy emphasis on the 18,000 US auto dealers. We've made it very clear that, making sure that they can sell and service vehicles is the first part of reducing kind of the anxiety around this.
I mean, and when you figure some of these targets that these companies have, yeah, and it's coming up quick. It's coming up very quick. 2030 will be here before we know it. A big thank you for joining us this morning. Charge Enterprise founder, CEO and chairman Andrew Fox, thank you for your time on Yahoo Finance today. All right, coming up, reports suggest TikTok could be looking at breaking off from parent company ByteDance. The move would have political ramifications and possibly create a very valuable asset. We'll get into that story next. China's TikTok is considering separating from its parent ByteDance to help address U.S. concerns about national security risks. That's according to reports from Bloomberg. Yahoo Finance's Dan Halley has the latest on that story. Dan, what are you hearing?
That's right, Rochelle. According to this report, TikTok could end up being divested from ByteDance, or ByteDance could divest TikTok. And TikTok could end up being worth between $40 and $50 billion. The big deal here is that U.S. regulators and politicians are unsure of whether or not TikTok is a national security threat, or if it's just a benign social media app. I think really what we're hearing is that it is, from at least the politicians' perspective, a threat. From the experts that I've spoken to, though, it really isn't. It's more of just a regular social media app that collects data as any other app does. And I think, when you're looking at stuff like this, the main concern I think that people have is that there's no really any kind of data privacy protection in the U.S., and that could solve a lot of these problems. But here, they're talking about divesting TikTok. This has been something that politicians have been calling for some time. TikTok has resisted. ByteDance basically saying, "Look, this is our company. Why do we have to ditch it and set it separate?" But really, I think the issue comes down to whether or not there's going to be data privacy protection, and what that means as far as what politicians are willing to put up with from American companies as well.
Well, hopefully we should be getting some of that clarity. I mean, what can we expect from TikTok CEO Shou Zi Cruz's testimony on Capitol Hill next week?
I think what it's going to be is a lot of political grandstanding. I think, there's bipartisan support for a ban on TikTok nationally. So you don't expect it to be a welcoming environment. I think the questioning will be rather hostile. There'll be probably questions about whether or not data is shared with the Chinese government on Americans, what the progress of their move to having American information on American servers has been. But I don't necessarily know if it's going to be a very substantive hearing, just because of the kind of rhetoric we've seen from politicians and regulators on TikTok. Again, there's been no solid proof brought forward that the app actually is a threat to Americans or national security for that matter, but they're going to be really going into the lion's den here.
Indeed. I'm sure a lot of other social media companies watching and waiting to see what happens there, see if they can benefit from that. Yahoo Finance's tech editor, Dan Howley, thanks so much. All right, coming up, the fallout from SVB continues, with the Fed reportedly looking at tougher capital rules for mid-sized banks. Shares in First Republic not having a good day following a junk rating from S&P. You see they're off more than 18%. We'll stay focused on that story next. Over half of all VC-backed companies called Silicon Valley Bank home. But for diverse founders, people of color and women, SVB was a crucial haven and sometimes the only institution willing to back them. Our own Ali Garfinkel joins us now to explore how those startups plan to move forward. Hey, Ali.
Hi, Rochelle. Great to see you. So I've spent the last 5 days talking to founders and VCs about what the long-term effects of SVB's collapse could look like. And there's one theme that has just emerged over and over and over: diversity. What that amounts to is that in many cases, diverse founders, people of color, and women who are looking to build their businesses often found that SVB was not only a willing partner, but their only banking partner. And just so you get a sense of the uphill climb, data shows that founders of color are far less likely to receive both VC funding and small business loans from banks. So you get a sense of this uphill battle, right? They were fighting this, and some data that really can stick out for you, Rochelle. In 2022, Black founders raised just 1% of all venture funding. And if you look at this graph here, those tiny lines at the bottom, that is the amount raised by Black companies as opposed to all funding for VC companies. I spoke to VC Asia Bradley about this. She's both an angel investor and a partner at Mendoza Ventures, and her practice focuses specifically on underrepresented founders. And this is what she said to me: only SVB was there for most of the underrepresented founders I know and work with. For underrepresented founders, they often can't get accounts at the top 4 banks. So the community of Black and brown founders has been reeling, asking, what are we going to do? The other thing she said is that it's a big blow to diversity in the ecosystem. Bradley still believes in regional banks as an avenue for founders, but that's going to get more complicated because one of the other things I have heard is that due diligence in Silicon Valley could be changed forever. One VC I was speaking to at Cameron Ventures told me that overnight they changed the metrics they were using. They changed some of the questions they were asking companies. For instance, where are you storing your cash? How many different banks? And there's going to be an emphasis on banks that are considered stable, which are more likely to be the top 4 banks. So we'll have to see how it plays out over time, Rochelle, but it's definitely going to be possibly what Asia Bradley said, a bigger blow to the diversity in the VC ecosystem.
And how confident was she that perhaps other banks who recognize the need for this might step in versus saying, look, this is already a risky environment for VCs. This is just a risk they're just not willing to take?
It's a really good question, Rochelle. I think from me, what I got from her was that she is very worried about it, that historically the data hasn't been good, showing that, for instance, immigrant founders are more likely to struggle to get a bank account from a top 4 bank. So I think there's definitely concern. That said, there has been a huge outpouring of support, not only for diverse founders, but for founders across the board. Every single founder I talked to, I think I talked to about 12, 13 just in the first 72 hours. And they all said they were completely impressed and completely floored by not only the VCs who stepped up for them, but by the community at large. So there is a lot of hope. There is some optimism, but definitely historically, it's an uphill battle, and it's hard to assume that it won't continue to be that way.
We'll certainly keep it on our radar. Ali Garfinkel, thank you there. Great update. Thanks so much. All right, coming up, a look at the wider impact of U.S. banking chaos on European banks. Our own Inez Ferre joins us next. Let's continue our coverage of the fallout from Credit Suisse with Ben Immons here, New Edge Wealth Senior Portfolio Manager. Ben, good to see you. Obviously, a lot of comparisons being drawn between 2008, the initial canaries in the coal mine that people missed, versus this. How would you compare them?
Hi, Rochelle. Thank you for having us. Yeah, I do think there are parallels here. It's interesting how the sequence of these events are similar as at that time. If you started off with some canaries that didn't matter to the markets, as in FTX, for example, last year, but then leading to some bigger events like the UK pension system, or back then the Bear Stearns hedge funds, we're now leading up to a situation where we may have a Bear Stearns type of a situation at our hand, with Credit Suisse being really in trouble and appealing now to the Swiss Central Bank for help. So markets are on alert that as you get these events, but in between a run on regional banks, there's a stress building in the system that's going to come out and leads us to some sort of a climax. Hard to predict what that then exactly is, but that's, I think, what markets are doing psychologically, being so on edge.
So then how likely are we going to see some of the mergers that we saw we saw with the 2008 crisis? Are we likely to see some more action there, or perhaps some more private investment coming into the space?
I think that's quite likely, because typically when you have the stresses building in one part of the market and it starts to spread, then you're going to get like certain entities start to quickly look at an opportunity to say, hey, here's really a way for us to show confidence to markets, but also a way, as in the valuations are getting better and therefore doing a deal, or it's out of indeed driven by emergency, maybe even driven by emergency as in governments, try and incentivize parties to come together to try to diffuse the situation. So will Credit Suisse, for example, be taken over by another bank here? That's all in the background here, but you can imagine that there's obviously negotiations going on how to resolve this, and that will be one way. Or you could see this show up in the regional banking space here in the United States, for example. Either way, I think it is something that's also similar to that 2007-8 period when you saw a company like Bank of America taking over Merrill Lynch and Countrywide.
So what about these unrealized losses then? How much of that is systemic then? Obviously, we're going to see a lot more scrutiny of that. But was that another red flag that should have been missed given the pace of interest rate hikes that we saw in the US?
It's incredible, actually, that these unrealized losses are now being such a focus, because it's actually an accounting measure that's been in the banking system for a long time. These are not like opaque losses. They are simple treasury bonds, but they're accounted for unrealized because of the specific accounting rules and regulations. And therefore, now it has a sudden focus because in the case of SVB, deposit withdrawals led them to the point of that they were facing a rating downgrade and they had to raise capital and used their treasury bond portfolio to raise that capital in addition to equity, but had to realize the loss, and that suddenly caused a confidence crisis. And so now people are looking at this larger unrealized loss in the entire banking system as a reason to not have confidence in the banks. So I think it's going to continue to put pressure on the financial sector, but we cannot expect them to do all that unwinding of those losses. If anything, the Federal Reserve's new lending facility that started on Sunday is actually designed to avoid that situation, as banks can pledge treasury collateral at the Fed at par and do not have to sell their treasuries in order to raise capital.
So then what are you expecting in terms of contagion? Obviously, Europe has a different level of exposure as well, but also we saw Asian banking, Asian financials rattled as well when this first broke. So talk about the contagion here and how contained do you think it might be?
There's certainly risks because you rightfully point out, this is not just an interest rate issue here, it's a global interest rate issue. Everywhere we dealt with the pandemic having an impact on inflation in a similar way, and everywhere central banks reacted in the same way by ratcheting up rates much faster than they've done over the last 20, 30 years. And this is the interest rate shock that we're now living through in this current crisis. It's coming to roost in order to, on banks' balance sheets that have to then, basically solve this issue by selling government securities. So, Japan Japanese banks hold almost 500 billion of government securities on their balance sheet, same in Europe. So people are looking at that as another pressure point. And yes, that could cause contagion or these fears of it and people reacting. So I do expect here somewhat more tremors from here to go.
And so then for people who are trying to find a safe space for their investments at this time, especially since we don't know for sure what the Fed is going to do, perhaps a 25 basis point hike, obviously still a lot of movement here as it is a very data dependent Fed. Where do you see some of the safe havens that people could perhaps park their money at this time?
So we're seeing it playing out live, Rochelle. Like the 2-year yield has now fallen more than 125 basis points from the high of just last week. So it tells us that that's where really the money is moving, and that probably will be at the moment at least, the safety that you could seek. But you don't want to be all into just treasury bills and 2-year notes. If this is still a situation where there is a financial stress, it will affect the economy. That's why interest rates are lower. But we're not in a Lehman type of situation just yet. Hopefully we don't get there, by the way. But I think, therefore, for investing, it's sort of a combination of, yes, you maintain liquidity and safety with treasuries and T-bills, but you also could look at opportunities in emerging markets, for example, or in Asia, or even in some of the really sound regional banks that are not in that kind of a situation that the SVB examples showed. So I think there's opportunity to invest there, but it's obviously a very uncertain environment. So being liquid and having treasuries in your portfolio is currently beneficial.
Indeed. Well, a big thank you. I'm glad you're able to join us this morning. Ben Emons there, New Edge Wealth Senior Portfolio Manager. Thanks as always. All right, well, shares of Credit Suisse along with European bank stocks falling sharply this morning as jitters from the SVB collapse spread. Yahoo Finance's Inez Ferrer is here at the Wi-Fi Interactive with a breakdown for us. Hey, Inez.
Hey, Rochelle, and I just want to show you what's happening with the sectors on the S&P 500 because, as you mentioned, financials really taking a hit today. And let's take a look at our banks chart so you can see a lot of these stocks that are underwater. You've got JP Morgan Chase, Morgan Stanley that's underwater. But we want to point out Credit Suisse, as you have been mentioning, down 18% right now. And over the last 8 sessions, it has been down. I'm going to pull up a 7-day chart here. Now, investors had been concerned about Credit Suisse for some time. Also, they saw problems when it comes to the credit default swap. Those prices were spiking higher. So you heard rumblings over the last couple of days that the bank may be in trouble because that is a type of insurance on default. So when those prices go up, you know that there's trouble. So we saw today also the stock going lower. This is also after the Saudi National Bank said that it won't give the bank any more assistance. This is its top shareholder, by the way, saying no more funds for you. So this is creating problems with the entire banking sector right now. We're seeing pressure on banks overall. I also want to point out what's happening with the regional banks because we saw what happened with SVB, the collapse of SVB, and we saw the impact that it had on the regional banks over the last couple of sessions. And I want to point out one in particular, which is First Republic. We've been watching this bank like a hawk over the last several sessions. On Monday, the stock was down a record 62%. Then yesterday, it rebounded more than 30%. It closed higher, and now it's down. This is after S&P downgraded the bank, its credit rating on the bank. So you're seeing that's part of the reason why you're seeing pressure on First Republic. So look, very different situations when you talk about Credit Suisse, when you talk about SVB, very different banks. Credit Suisse much larger than SVB, different dynamics, different situations, different set of issues. But nonetheless, this is creating concern within the banking industry. Rochelle?
Certainly terrible timing, to say the least. We know that billionaire Ray Dalio, though, has some thoughts on what the collapse of SVB means for the world financial system. What did he say?
Yeah, that's right. He basically said that the SVB collapse shows that the cracks are widening in the global finance industry as a whole. He also said that the collapse of the bank will be followed by more problems before the contraction phase of the cycle runs its course. He wrote this in an open letter. Also, a similar tone was struck by BlackRock's CEO, Larry Fink, basically saying that some banks may have to pull back lending in order to shore up their balance balance sheets, also saying that you're going to see stricter capital standards following SVB's collapse as well, Rochelle.
We'll certainly continue to keep an eye on all those updates. And Esfray, thank you so much. Right, coming up, we're far from done with the SVB story. Next, we get the view from veteran financial journalist and host of Truth or Skepticism, Dylan Rattigan. Don't miss it. Checking in on the markets here, sponsored by Tasty Trade. We see all three still in negative territory, though well off their session lows. The Dow there down more than 470 points, about 1.5%, weighed down by, of course, those financials as we continue to monitor some of the aftermath of what we're seeing with Credit Suisse, and also seeing a little bit of weakness in energy as well. That's also dragging on the Dow. The S&P 500 off more than 1% on the day as well, down 50 points. And the Nasdaq there down about 0.5% on the day, at least faring better than the Dow and the S&P so far. Right, well, ChatGPT, the newest version of OpenAI's artificial intelligence chatbot, is touted to be more reliable, creative, and nuanced than its predecessors, ChatGPT 3 and 3.5. Equipped with image support, ChatGPT 4 is able to accept image and text inputs to gain a deeper level of understanding. Now, looking at this chart, we see that ChatGPT 4's performance on a variety of exams, and in most cases, it performed significantly better. Now, the new model was able to pass a simulated bar exam with a score of around the top 10% of test takers, while GPT 3.5 came in the bottom 10%. Now, GPT-4 is currently available for ChatGPT Plus subscribers with a usage cap. Well, turning back to SVB's collapse, which draws comparisons to the banking industry meltdown in 2008. Now, the Fed in particular facing criticism for missing red flags before the bank's rapid demise. But what were those signs? Joining me now is veteran financial journalist and host of Truth or Skepticism on Tasty Trade, Dylan Rattigan. Good to see you, Dylan. So clearly plenty of blame to go around. We know that management of SVB has gotten a lot of blame for this, but also the Fed as well. What were some of the top warning signs that you think were missed?
Well, it's interesting because I actually see almost no similarities between what's happening right now in 2008 and 2009. other than the fact that it's bank stress, which, but in terms of what's causing it, I see no similarities. In 2008 and 2009, you had blanket issuance of loans that were not going to be paid back. You had no credit standards, and you had rating agencies assigning AAA ratings to loans that would be junk on a good day. In this situation, you have an interest rate inversion where the whole principle of buy short and lend long, which drives banking, was grossly mismanaged by the people at SVB. They have a long loan book that doesn't pay enough, and the short borrowing rates went from nothing to 6%, 5%. So they were screwed. But that's not a banking issue. That's a terrible management. Everybody, everybody knew short rates were going higher, and every other bank in the country, or most of them, was either had a rate hedge on or some other accommodation in anticipation of that fact. It's not the first time that short rates have gone up and you have to adjust your book. And so I think that the big distinction between what's happening now and what happened then is now you're not dealing with bad loans. You're dealing with a change in the cost of short-term borrowing rates that's creating stress for banks that are poorly managed, which right now is one or two of them. The real risk is that people think that this is the same as that, and it creates a panic like that. It's like believing the house is on fire when it's not, creates the dynamic of a fire that's not really there. And that's actually the biggest risk. And then furthermore, you add the Credit Suisse situation, which everybody has known for years that Credit Suisse is undercapitalized and in the weeds. And their biggest shareholder finally cut them off. But Credit Suisse getting powdered basically is also uncorrelated. So you have bad management that couldn't manage their bank, whereas in the past you had bad loans that had infected the entire system. And so that's a massive distinction. And I think that it's important to make that distinction, because if you mix them together, you create behavior that really exacerbates it. Like First Republic, I think, is the biggest buying opportunity on Wall Street right now. I think it's comical that First Republic is down 80%. For what? It doesn't even make any sense. So I think that the most important thing is that people don't understand why this is happening, because they don't understand how banks make money. But once you understand, banks loan money long term, and then they borrow money short term. And when short term borrowing rates go up rapidly, which they did, and long term rates, or your long term yield that you're collecting is fixed, you've got a problem. Now, that's something that there's a million ways to fix, and managers do, but they didn't at Silicon Valley Bank.
And Dylan, we know that a lot of people talking about the rollbacks from Dodd-Frank. You have Senator Warren here pushing for more legislation here. Is there anything regulators could have done to prevent this?
Of course, I'm sure there's no question they could have been monitoring risk management. In other words, if you looked at the Silicon Valley book and you're like, well, hang on a second, you guys have all of this relatively low yield long paper that pays whatever 2 or 3 or 4%, and your entire business model is based on 0% short-term borrowing rates forever, and you have no hedge. You should do you can't do that, right? Like, I mean, that's something that a regulator would say, you have to put some sort of a hedge on this, because what are you going to do when rates go from 0 to 6? So for sure, there's a regulatory failure there. But I also think, again, it's political opportunism, because everybody was so traumatized in 2008 and 2009 for good reason. Any bank failure now is immediately associated with that, even if it has nothing, even if the catalyst for it has nothing to do with that. And so whether it's Senator Warren or anybody else, for me, that's just political opportunism. And I still look at whether it's the Credit Suisse issue or the SVB issue as an entirely contained issue. And I would even say that this is fabulous, because to the degree to which inflation was an issue, to the degree to which an overheated economy was an issue, to the degree to which we were compelled to have all these Fed rate hikes, well, to the Larry Fink and Ray Dalio point, I can assure you there will be a credit contraction, which would be the equivalent of all sorts of Fed rate hikes. Inflation for sure will come back. and the Fed will soon be cutting interest rates. And so this basically synthetically and rapidly reduces the gas on the heat of the available credit, which then makes the entire economy slow, which then reduces inflation, which was the whole point of the rate hikes in the first place. This is doing the Fed's work for them.
So then, as we look at this landscape, then who do you think could be next? That's what a lot of people are wondering. And also, when you look at what happened with the Signature Bank, a lot of focus on the crypto exposure and the risks there, but seems to be treated a lot more unfairly. At least some crypto fans are saying, than some of the disruption that we saw in the traditional banking sector with SVB.
Yeah, I mean, you know, the crypto issue is a different issue, and the only path forward for crypto is to be regulated, and it would be the best thing that would happen to crypto is for it to be regulated. I don't know enough about the Signature Bank situation, honestly, to say something that's really going to be useful to your audience, other than that, you know, another evidence of concentrated risk and bad management. The thing that destroys banks is concentrated risk, bad management, and leverage. Every time. And so surely it's some combination of those things, but I just don't see where this is anything like 2008 or 2009. Like the whole idea that Credit Suisse is the same thing as Bear Stearns and that this is the canary in the coal mine. I just think that is wrong. And the reason I think that that's wrong is because the issue is not bad loans. The issue is short-term illiquidity due to bad management because of the rise in short-term interest rates. And short-term interest rates are coming down because the 2-year is now the most desirable fixed income asset in the world. You know, and so already short rates have come down. So the pressure is already half what it was a week ago. And so I don't know that there needs to be a next. If anything, I think that buying the regional banks is the opportunity of a lifetime right now.
Well, we've certainly seen Bank of America at least reaping the benefits of some of the concerns that people have seen with regional banks. A big thank you there to Tasty Trade's Truth or Skepticism host, Dylan Rattigan. Great to have your insights on the show today.
Nice to talk.
All right, well, let's do a final check of the markets to see where they stand at the moment. Obviously, still deeply in red territory. The sell-off actually continuing. We're seeing the Dow there up now, down more than 580 points on the day, down 1.8%. The S&P 500 also still under pressure to the tune of 1.5%, down about 60 points on the day. Tech-heavy Nasdaq, they're also down 0.86%, about 100 points on the day. Well, that'll do it for now. I'm Rochelle Akufo, but do stay with us. Yahoo Finance will be back, and I'll be back with you tomorrow at 11 a.m. Eastern. See you then.